Hello, I'm Hans Lee from Livewire Markets, and this is The Pitch. Joining me today, Michael Colbert of Perpetual, and we're going to be discussing all things credit, and specifically the value that floating rate credit can provide to investors. So, Michael, just to start with, why should Australian investors consider exposure to credit markets right now?
At the moment, floating rate credit is offering really attractive absolute returns. We've got fairly high interest rates, we've got good credit margins, performance in the sector is doing really well. So I think that the absolute return that's being offered relative to, I guess, some of the riskier asset classes, equities, etc., is pretty good at this point in the cycle. And, that return is a predictable return. These cash flows within credit markets are contractual cash flows. They compound in a predictable way. And so, at this point in the cycle, we think the total returns are really strong. The predictability of returns is really high, and the outcome for investors is looking pretty good.
It's interesting. Australian investors like to talk about how we are very different from the rest of the world, and I think stocks investors like to talk about, well, we're very dividend heavy, we're very franking heavy, which makes us very different to the rest of the world, and it makes our story quite different. I'm curious, from a credit investor's perspective, how is Australia different from, say, some of our global peers?
Yeah, the Australian market, I guess, has evolved more recently over the last 20 or 30 years. And it's evolved in a legal framework which is very robust. So the legal framework is very friendly to lenders in Australia. The economic environment tends to be more stable. We've got a lot of more concentrated corporates. You think Coles, Woolworths, the major four banks. So the environment is actually less volatile than some of the offshore universe. But at the same time, it's a very sophisticated, legally protected and fairly diverse universe. I think offshore, there is just the level of risk is greater. There's more opportunity for diversification, but there's also probably more volatility as well.
Yeah, no, absolutely. So if I kind of think about where we are in the macro cycle, you talked about interest rates earlier. Most market participants seem to be sure that the next move for rates will be down. I'll let you and you kind of give a counter opinion to that if you want. But what impact will that have, if any, on floating rate investments?
Yeah, look, our view has been that inflation is a stubborn beast, and higher for longer is definitely, I think, a core case. But at some point, that will begin to moderate. Floating rate credit is really good because it doesn't have the capital risk that bond portfolios do. So it tends to follow the economic cycles. As inflation moderates, returns will moderate, but you'll have a very capital stable, again, a very predictable, performance outcome in the sector.
Yeah, no, absolutely. Okay, so passing all this together then, what is a high conviction investment you have in the portfolio that you might be able to share with us?
Yeah, look, a couple of different examples. I think one of the things that we try to do in our portfolios is to embrace the diversity that's available in Australia. We're not a sector, we don't invest into narrow sectors, we embrace the whole universe. So a couple of examples I'll give you. One through COVID that we thought was a really good investment and performed well for us, and it gives you some sense of how we look at the market, I guess, was Qantas. Airlines are a volatile business. Through COVID, they looked pretty tenuous in their creditworthiness, but we had a strong view that they had such a strong market position within Australia, and that the cycle would eventually support them again. That at a point in time where their prices were very stressed, they would perform, and that was a great trade for us. More recently, we've seen the banking sector issue a lot of subordinated debt, and we've
subordinated meaning like tier 2, you mean, is what you mean?
Yeah, tier 2. So this is that middle rank between the senior deposits and the junior rank that domestically we have in the income security space. So just one level below senior. So the banks have issued a fair bit of that, both in Australia and offshore. We do look at the markets both domestically and offshore, and and we certainly saw good opportunities, names like NAB, names like Macquarie, to invest in US dollar sub-debt, subordinated debt, and that's performed very well for us.
And if I could just illustrate and press the point, when you're talking about investing in those tier 2 bank bills, what kinds of yields are you looking at, total yields in that space?
Yeah, you're looking at yields up around 7, 8, 9%, something like that. And I think one of the things that we try to do is to be very active investors. So we will try to invest when a particular security is selling at a yield which is quite cheap. And with a view to not necessarily holding it through to maturity, but to see that price improve and to cash out. So, for example, the NAB and the Macquarie securities that we held, they're 10-year securities, but we hold them only for 12 months. Once they recover, the revaluation, the improvement in price is actually much greater than the running yield or the coupon that you're receiving.
Yeah, no, absolutely. Thank you for explaining that to us. That's Michael Corber there from Perpetual. And thank you for joining us for The Pitch. If you enjoyed that episode, you can subscribe to the Livewire Market Index websites as well as our YouTube channel where you can find more episodes of The Pitch. Thanks for watching.